Have you ever watched someone try to hold a beach ball underwater? They push down with all their strength, but the moment their grip weakens, that ball rockets to the surface with explosive force. That's exactly what just happened in the silver market. And the people who tried to push that ball down aren't giving up. They're regrouping, changing tactics, and preparing for another attempt. The question isn't if they'll try again. The question is, what happens when an already failing system attempts the same manipulation twice? On May 1st, 2011, silver touched $49.50 per ounce. It was a Sunday. The world was distracted by breaking news that Osama bin Laden had been killed. While media attention focused elsewhere, the CME Group, which operates the COMEX futures exchange, made an announcement that would change everything. They raised margin requirements by 13%. Then they raised them again on Monday, and again on Wednesday. By Friday, they had executed 5 separate margin hikes in 1 week. The price of silver collapsed by 30% in just 4 days. Traders who couldn't meet the new margin calls were forced to liquidate their positions. The hunt was over before it really began. This was called a slam in trading circles. A coordinated effort using paper contracts and exchange rule changes to artificially suppress price discovery. The banks that held massive short positions breathed a sigh of relief. The retail investors who believed in silver's fundamentals watched their accounts evaporate. The lesson was clear. The exchange could change the rules mid-game, and there was nothing anyone could do about it. Fast forward to September 2020. J.P. Morgan Chase admitted to committing wire fraud in precious metals markets. The bank entered into a deferred prosecution agreement and paid $920 million. This wasn't a rogue trader. This was systematic. Between May 2008 and August 2016, traders on J.P. Morgan's precious metals desk engaged in tens of thousands of deceptive trading sequences. They used a technique called spoofing. Place large orders you have no intention of filling to create false supply signals. Cancel those orders milliseconds before execution. Pocket the profit from traders who reacted to your fake signals. The Department of Justice didn't just charge individual traders. They charged the entire precious metals desk under RICO statutes. The Racketeer Influenced and Corrupt Organizations Act, the same law used to prosecute organized crime syndicates. Michael Novak, who ran J.P. Morgan's global precious metals desk, was sentenced to 1 year and 1 day in prison. Greg Smith, an executive director and trader, received 2 years. The CFTC called it the largest monetary penalty ever imposed in a spoofing case. But here's what matters. Despite the convictions, despite the fines, despite the prison sentences, the fundamental structure of the COMEX hasn't changed. The same banks still hold concentrated short positions. The same leverage ratios still exist. The same margin requirement tools are still available. The only difference is that now they know the world is watching. Let's examine what happened in recent trading sessions that proves the old playbook is failing. Silver had been climbing steadily through 2024 and into 2025. Industrial demand from solar panels and electric vehicles had reached record levels. In 2024, industrial silver use hit 680.5 million ounces. Solar photovoltaic production alone consumed more than 200 million ounces. That's 17% of total global silver demand, up from just 5.6% in 2015. The supply side couldn't keep pace. Global silver mine production in 2024 increased by less than 1% to 819.7 million ounces. Meanwhile, total demand reached 1.16 billion ounces. That's a structural deficit of over 200 million ounces. For the 5th consecutive year, the world consumed more silver than it produced. By October 2025, silver had broken through $34 per ounce, then $40, then $50. On October 17th, it touched $54.46, surpassing the April 2011 high of $48.70 that had stood for 14 years. The iShares Silver Trust, the largest silver ETF, saw $644.3 million in inflows during just the first half of 2025. Its holdings reached 1.13 billion ounces. Then came the slam attempt. Following the historical playbook from 2011, the CME announced an emergency margin hike. The maintenance margin for silver futures was raised substantially. The move was designed to force leveraged speculators out of the market. Force selling would trigger stop losses. A cascade of liquidation would drive the price down. The banks holding short positions would cover at lower prices. Crisis averted. Manipulation successful. Except it didn't work. Not this time. Silver barely flinched. After the margin hike announcement, the price dipped briefly from the low 60s to around $64. That's roughly a 1% decline. In 2011, the same tactic had produced a 30% crash. Something fundamental had changed in the market structure. The old kill switch had been pulled, but the machine kept running. Why did the manipulation fail? The answer lies in the physical market versus the paper market. In 2011, silver was primarily a speculative vehicle for hedge funds and day traders using extreme leverage. When margin requirements doubled, those players couldn't meet the calls. They sold. The physical market was irrelevant because nobody was taking delivery. It was just numbers on screens. But 2025 is different. Industrial users aren't trading on margin. Tesla doesn't leverage up to buy silver paste for solar panel production. Samsung doesn't use borrowed money to secure metal for electronics manufacturing. First Solar doesn't care what the COMEX maintenance margin is. They need physical metal, and they need it now. When the slam hit and paper prices dipped, industrial buyers stepped in and absorbed every available ounce. The COMEX registered silver inventory tells the real story. Registered inventory represents metal that's actually available for delivery against futures contracts. In early 2025, registered stocks stood at approximately 73 million ounces. That sounds like a lot until you realize that total open interest in silver futures represents obligations for hundreds of millions of ounces. In August 2025, the London Bullion Market Association reported that silver inventories had fallen 7.5% year over year to 792 million ounces. That was a multi-year low. Here's the critical insight. You can manipulate paper prices with margin hikes and coordinated short selling. You cannot manipulate physical scarcity. The solar industry alone is projected to consume over 700 million ounces annually by the end of 2025. Electric vehicle production requires 25 to 50 grams of silver per vehicle. With over 17 million EVs expected to be sold globally in 2025, that's another massive source of inelastic demand. Inelastic means the price doesn't matter. If a solar panel manufacturer runs out of silver paste, the entire production line stops. Workers go home. Contracts with governments for renewable energy projects get breached. The stock price collapses. So when silver briefly dipped after the margin hike, procurement managers at these companies didn't celebrate a buying opportunity. They panicked and bought more aggressively, terrified that another price spike would leave them unable to source metal at any price. The banks know this. They watched their margin hike fail in real time. They saw the lack of forced liquidation. They recognized that the physical bid is now too strong to overwhelm with paper market tactics alone. So, what will they try next? Tactic number 1 will be even more aggressive position limits. The Commodity Futures Trading Commission has the authority to declare a market emergency and impose caps on how many contracts any single entity can hold. But here's the corrupt part. These limits typically exempt commercial hedgers, which include the very banks that hold the concentrated short positions. So retail traders and hedge funds get forced out while the banks maintain their positions. It's rigged from the start. Tactic number 2 involves targeting the ETFs. The iShares Silver Trust and other physically backed funds have become enormous buyers of actual metal. When investors buy shares of SLV, the fund must purchase physical silver to back those shares. This removes metal from the available supply and supports the price. The banks will lobby for regulatory changes that restrict ETF creation or force cash settlement instead of physical delivery. They'll claim it's about market stability. The real goal is breaking the link between paper price and physical demand. Tactic number 3 is the windfall profit tax threat. Politicians will be encouraged to characterize silver investors as hoarders who are holding the green energy transition hostage. Sound ridiculous? It's already started. As silver prices soared past $50, articles appeared warning about speculation driving up costs for solar manufacturers. The narrative is being shaped. If silver hits $70 or $80 per ounce, expect legislation proposing special taxes on precious metal sales. The goal is scaring holders into selling before they get taxed on their gains. Tactic number 4 is the most insidious: force majeure declarations. This is a clause in contracts that allows a party to walk away from their obligations due to extraordinary circumstances beyond their control. Almost every bullion dealer and futures exchange includes market dislocation or extreme volatility as valid reasons for force majeure. Translation: if they can't deliver the metal they promised you, they can instead give you cash based on a price they determine. Imagine silver trading at $80 per ounce, but you get paid out at the last closing price before the force majeure declaration. You lose the upside, and you lose the metal. The Silver Institute reported a global silver supply deficit of 282 million ounces in 2024. The forecast for 2025 indicates the deficit will continue. Mine production isn't increasing fast enough to offset industrial consumption growth. Recycling provides some relief, but can't close a gap this large. The physical shortage is real and getting worse. This creates a nightmare scenario for the shorts. In a normal commodity market, high prices bring new supply and destroy demand. But silver isn't normal. You can't substitute silver in solar panels without reducing efficiency. You can't replace silver in electric vehicle electronics without compromising reliability. And you can't just turn on new silver mines. Major mining projects take 7 to 10 years from discovery to production. The banks holding short positions on COMEX are trapped. If they try to cover by buying contracts, they'll drive the price higher, making their remaining shorts more expensive. If they try to deliver physical metal, there isn't enough registered inventory to satisfy all the contracts. If they declare force majeure and cash settle, they destroy confidence in the entire futures market and potentially face lawsuits. This is why the next slam attempt will be more desperate and more coordinated. Expect multiple tactics deployed simultaneously. A margin hike combined with position limits, combined with regulatory pressure on ETFs, combined with media campaigns about speculation. The goal will be creating enough chaos and uncertainty to trigger a sell-off, even if the fundamentals haven't changed. Here's what makes this situation unprecedented. In 2011, the manipulation worked because the paper market was bigger and more important than the physical market. In 2025, the physical market is asserting dominance. Every ounce that gets delivered and leaves the warehouse system reduces the available float. Every solar panel factory that stockpiles metal removes it from circulation. Every central bank that starts treating silver as a strategic resource changes the game. Russia announced in 2025 that it would purchase $535 million worth of silver over the next 3 years. That's the first time a major central bank has disclosed significant silver purchases in decades. They understand that silver is both a monetary asset and a critical industrial metal. As geopolitical tensions increase and countries focus on supply chain security, expect more governments to build strategic silver reserves. China, which controls 57% of global silver refining capacity, has been prioritizing domestic use for its renewable energy and electric vehicle sectors. Chinese silver exports to London have surged even as Shanghai inventories collapsed. They're selling refined product to earn dollars while hoarding domestic production. This is classic resource nationalism. When push comes to shove, China will restrict exports to ensure its own industries have the metal they need. The solar sector provides perhaps the clearest view of why physical demand will override paper manipulation. The global solar industry grew 76% in 2023 and another 34% in 2024. This isn't slowing down. The International Energy Agency projects that solar photovoltaic capacity needs to reach between 18 and 63 terawatts by 2050 to meet climate goals. Currently, we're at around 2 terawatts. The amount of silver required for this expansion is staggering. Newer solar panel technologies like TOPCon and silicon heterojunction cells actually use more silver per panel than older PERC technology. TOPCon uses 1.5 times more silver. Silicon heterojunction uses twice as much. So even as manufacturers work on thrifting to reduce silver content per cell, the shift to higher efficiency panels is offsetting those gains. Some forecasts predict solar alone could consume over 250 million ounces annually by 2030. The automotive sector adds another layer. A traditional internal combustion engine vehicle uses 15 to 28 grams of silver. A hybrid uses 18 to 34 grams. A battery electric vehicle uses 25 to 50 grams. As EV adoption accelerates, silver consumption from this sector will double or triple. The International Energy Agency predicts that by 2035, every other car sold globally will be electric. That's not a forecast you bet against by holding paper shorts. Here's where it gets interesting for the shorts. Mine supply is actually expected to decline toward 2030. Mexico, the world's largest silver producer, faces political headwinds. Proposed bans on open-pit mining could slash 60% of Mexico's silver output. Peru, another top 5 producer, deals with ongoing anti-mining protests that have stalled projects. Chile saw production decline by 8.8 million ounces year over year in 2024. Russia, Bolivia, and Kazakhstan are also projected to see declining output. The silver mining industry was starved of capital for a decade as prices remained depressed. Companies cut exploration budgets and didn't develop new projects. You're now seeing the consequences. The pipeline of new mines coming online is extremely thin. Most silver is produced as a byproduct of copper, lead, and zinc mining. You can't just ramp up silver production without economic incentive to mine more of the primary metals. This supply-demand imbalance is exactly what triggered the historic runs in 1980 and 2011. The difference is that those previous peaks were primarily driven by investment speculation. The Hunt brothers in 1980 tried to corner the market through hoarding. In 2011, it was ETF flows and fear about the financial crisis. Both rallies collapsed when investment demand evaporated. The shorts could wait it out because industrial demand was relatively stable. In 2025, it's the industrial demand that's driving the structural deficit. Solar manufacturers can't wait out high prices. They need silver today, and tomorrow, and next year. This demand is sticky. It doesn't go away when traders get scared or margin requirements change. It's locked in by production contracts and government renewable energy mandates. The gold-to-silver ratio provides another perspective. Historically, around 15 ounces of silver have been required to purchase 1 ounce of gold. That ratio is based on the relative abundance in the Earth's crust. In modern markets, The ratio has been as high as 90 or even 100 to 1. As of late 2024, the ratio was in the mid-70s. If the ratio returns to historical norms around 60 to 1, and gold is trading near $3,000 per ounce, silver should be at $50. If it drops to 40 to 1, silver reaches $75. This is basic mean reversion. The technicals also support a continuation of the rally. Silver broke above its 200-day moving average of $30 in 2025 for the first time since 2011 through 2012. That's a major psychological level. Once a commodity establishes a new price regime above a long-term moving average, it tends to defend that level. The breakout above the 2011 high of 48.70 was the key. That resistance level had held for 14 years. Breaking it signals a regime change. Volume patterns during the recent price action show something critical. When silver dipped after the margin hike, volume didn't spike the way it would in a typical capitulation. That means holders didn't panic and sell. Instead, the dip was bought quickly. This is classic bull market behavior. Weakness gets absorbed by new buyers eager for entry points. The lack of selling pressure, despite exchange manipulation, is perhaps the strongest signal that the market structure has fundamentally changed. Silver lease rates in London hit 30% in October 2025. Lease rates are what you pay to borrow physical metal. When lease rates spike to 30%, it means there's a severe shortage of immediately available metal. Entities that need silver for delivery are bidding aggressively to borrow it. This happened during the 2020 silver squeeze and briefly in 2021. But sustained lease rates at these levels haven't been seen since the 1990s. It indicates genuine physical tightness, not just speculative fervor. COMEX warehouse inventories tell a complementary story. While registered stocks fluctuate, the total COMEX silver inventories declined from over 400 million ounces in early 2021 to around 291 million ounces by April 2024. That's a 27% decline in 3 years. Where did that metal go? It was either delivered against contracts and removed from the system or transferred to other locations. Either way, the buffer that allows the exchange to function is shrinking. The London Bullion Market Association doesn't publish how much of its reported inventory is actually available for delivery. A significant portion backs unsecured silver ETF holdings. When you subtract the metal that's allocated to funds, the free float is much smaller than the headline number suggests. Some estimates put the truly available London silver at under 300 million ounces. For context, global industrial demand alone is around 700 million ounces per year. That's less than 6 months of supply sitting in the vault. What happens when they try the next slam? Based on the current market structure, here's the likely sequence. They'll announce new margin requirements and position limits. The media will run stories about speculative excess and the need for market stability. The CFTC will hold hearings about volatility in commodity markets. ETF issuers will face pressure to suspend new share creation. Politicians will introduce legislation taxing precious metal sales. The price will likely dip initially, maybe 10 to 15% over a few days. Weak hands and leveraged players will be shaken out. The financial media will declare the bubble has burst. But then, something different will happen. Industrial buyers will step in. Sovereign buyers will step in. The physical bid will absorb the available supply at the lower price. And within weeks, the price will be right back where it started, or higher. Each failed manipulation attempt makes the next one harder. Every time the shorts try to cover, they provide buying opportunities for accumulation. Every ounce that moves from exchange warehouses into private hands or industrial stockpiles reduces the available supply for manipulation. The system is breaking down, from physical reality overwhelming paper fiction. The ultimate resolution likely involves a significant repricing. Not just to $70 or $80, but potentially above $100 per ounce. When silver crosses triple digits, it becomes more than a commodity story. It becomes a monetary event. At $100, the gold-to-silver ratio would be around 30-to-1 if gold is at $3,000. That's historically tight, but not unprecedented. The implications ripple across multiple markets. Silver mining stocks would see explosive revaluation. A producer with all-in costs of $20 per ounce, making $80 profit per ounce, trades at completely different multiples than when making $5 per ounce. Expect a wave of merger and acquisition activity as tech companies and sovereign wealth funds try to secure supply by buying mines directly. The green energy transition depends on silver availability. If prices rise to $100 per ounce, solar panel costs increase, but not enough to stop deployment. The silver paste in a panel represents a small fraction of total system cost. It's the availability that matters, not the price. This is why industrial users will pay whatever it takes. For the banks holding short positions, the end game approaches. They can try increasingly desperate manipulations that each fail more quickly than the last. They can declare force majeure and face legal consequences that destroy the credibility of the futures market. Or they can capitulate, cover their shorts at massive losses, and watch silver price discovery move to the physical market where it belongs. The failed COMEX slam wasn't an aberration. It was a signal. The old system is dying. The manipulation that worked for decades is failing against the reality of supply deficits and inelastic industrial demand. When they try again, and they will try again, expect the same result: a brief dip followed by renewed buying. Each attempt will be less effective than the last. The beach ball is done being held underwater. The grip has weakened. The force pushing up is stronger than the force pushing down. What comes next isn't a question of if, but when. The physical market is reasserting itself against decades of paper suppression. The COMEX slam failed. The next one will fail harder. And eventually, the shorts will realize there's no winning this fight. The smartest money has already figured this out. That's why silver-backed ETFs saw record inflows in 2025 despite prices rising. That's why lease rates are at 30%. That's why industrial users are signing long-term supply agreements directly with mines, bypassing the exchange entirely. The market structure is being rewritten in real time. Those watching for another slam are missing the bigger picture. The slam already failed. Now, we're just watching the slow-motion recognition that the manipulation era is over. Silver's journey from $25 to $60 wasn't speculation. It was fundamentals. The journey from 60 to 100 won't be either. It will be mathematics. Supply minus demand equals price. When demand exceeds supply by 200 million ounces per year and new supply can't come online fast enough, price must rise until either demand is destroyed or new supply emerges. Neither is happening. Solar deployment isn't slowing, EV production isn't stopping, and new mines aren't being developed fast enough. The COMEX slam failed because you can't manipulate physical reality with paper contracts. The next attempt will fail for the same reason. This isn't financial analysis, it's physics, and the shorts are about to learn that lesson the hard way. What do you think will happen when the next manipulation attempt comes? We've covered the history, the failed tactics, and the fundamental reasons the old playbook is obsolete. But markets are shaped by participants. Share your thoughts in the comments below. Have you noticed changes in the silver market that suggest the manipulation era is ending? Are there aspects of this situation we didn't cover? Subscribe to stay informed as this story continues to unfold. The next chapter is being written in real time, and you don't want to miss what happens when an unstoppable physical demand meets an immovable paper short position. The failed slam was just the beginning.